I'd like to thank everybody for joining me today. Today, I want to talk about using split dollar loans as a way to reward our key employees. As you think about this, as we have these key employees, can we do more that would be beneficial for them and also tie them into you as the employer? And remember, when we're talking key employees, a lot of times our key employee might be the owner of the company. And a lot of times this is a great way to help them, take more money out of their business in a way that is beneficial to them in their estate planning as well. If you think about all of this, we want to think outside the box with our planning and make sure that we're doing a good job for our clients. So ask yourself, do you have a key employee of the company? Does the business adequately compensate the key employee? And these are two big things, because if we have key employees, are we doing a good job for them and creating a place where they want to stay forever? Because if we lose our key employees, we have to train somebody. We may not be able to get back some of the clients that may leave, some of those business relationships. So rewarding our key employees are a great thing. With split dollar, what's nice, these are not ERISA-based plans, so we can pick and choose who we're going to benefit. So we might be able to benefit the owner employee. We might be able to get our C-suites or our CEO or CFO, those types of people, and our key managers. And think about this. These are people that make the engine run. These are the people that if they didn't show up to work, it's going to be, harmful to our business. So think about that key employee. Are we compensating them in a way they want to stay? And the employment world is becoming smaller and smaller. So we don't want to lose our key employee, because somebody offers them a better job that they can do online or do it from home, whatever. So start thinking outside the box. With split dollar loans, and split dollar can be set up a lot of ways. Today, I'm using a loan. We're going to have the key employee own a life insurance policy. The company is going to pay the premiums and treat those as loans with interest. We're going to have a collateral assignment. That's going to be the lien against the policy. It's going to lien the cash value, and it's going to have a lien against the death benefit, so that our company gets repaid for the money that they paid out. The key employee can access that policy cash value that's in excess of the lien. So remember, our company is always going to be protected, but if we grow more cash value in this plan, the key employee will let them access anything above the lien. But here's the best part of this. There's no income tax, generated from this. So we're not taking a deduction as the employer. We're treating it as a loan. So on our books, we move money from cash to a loan receivable. We're not generating a deduction so therefore we don't have our key employee recording or reporting income on this as well. So let's look at this. I think it always makes sense when we start looking at real situations. So in this case study, as the employer, we're going to set up a split dollar loan for our key employee. They're going to pay in premiums of $25,000 per year for 10 years, and we're going to terminate this plan in 15 years. So we'll look at different ways to exit out of this. So when we always look at this, we want to look at results from both the employer's standpoint, and we want to look at it from the employee's standpoint. It's got to be a win-win. And this is a nice win-win strategy. So the first thing that we look at is, how much is our employer going to commit to pay in? And so this is just looking at paying in $25,000 a year for 10 years. So as long as our key employee is employed by the company, each year they're going to pay in that $25,000. That is the maximum commitment we're making. And like I said, this is going to be treated as a loan. So think about, as money leaves the company, leaves the checkbook, on our balance sheet, we've moved from cash to now we have a loan receivable. So our net assets have not changed as the employer. this is going to be where we start seeing the first part of that lien, that collateral assignment. So we put that collateral assignment to show the lien at the insurance company. So all of the cash value of this policy stays with the company until they're made whole. So, you'll see this in year one, they paid in 25,000. There's only $5,000 of cash value. All of that belongs to the company. But if you go out to year 10, the company's paid in 250,000, and we have a little bit extra cash value that we now will see over in the employees bucket. Our company is now made whole if they need to cash this policy out. The policy death benefit. If the employee were to die, the employer gets paid their loan first. The rest goes to the employee's heirs or beneficiaries. So in this case, you just look down through there. Once we max at 250,000, that's what total we put in. That will never go above that because our employer's not putting in more than 250,000. So from the employer's side, they're making the loan, they're made whole. From the employee's side, you look at this, what are they paying? Well, they have to have the interest. So the interest after tax is going to actually cost them, this 220,000 in year one. We're assuming that interest cost in this case is going to be treated as a taxable bonus to the employee, and they'll pay tax on that as if it was received. Now, if I come back over and start looking at this, the employee has access to cash value, but only after the employer is made whole. So there's no cash on the employee's side of the ledger until starting in year 10. The death benefit, if the employee leaves, if the employee dies, the employee's heirs don't get anything until the employer's paid off. So until that loan balance is paid in full. So in year one, if the employee were to die, 25,000 of death benefit goes to reimburse the employer. 994,000 and change will go to the employee's beneficiaries. So stop and look at this and think about the benefit we've created now. Now our employer has done something different in compensating this key employee that goes beyond just a normal paycheck. Now, from the employee's family standpoint, the employer's taken an interest in making sure that the key employee's family is taken care of in the event of a death. And over time, they'll have access to cash value that can be accessed income tax free. But now we've reached out because we've thought outside the box. And now our employees understand we care about them. We care about their family. This is a benefit that's different than everybody else. So if our employee gets an offer to go join another company, well, hold it. Do you have this kind of a program? Most companies don't. Therefore, we've offered them something that can incentivize them to stay. And we've promised to do this for 10 years as long as they're employed by our company. Now, I said at the end of 15, in 15 years, we want to roll out of this. We want to eliminate this plan. Well, one way we can do this is take the cash value and pay back the loan with the cash value from the life insurance policy. And so we've got 250,000 of cash value. That's being used to pay back the employer. The employer's now happy. They got paid back. And the employee now has what? Well, they have access to all of the remaining cash surrender value, and they have the death benefit. So you start looking at all of this and say, here's all the benefit for this employee. Now, the employee could have paid this off with other money, if that makes sense. The employer could treat this as a bonus and bonus them out the remaining part of this and treat it as taxable. But I look at this as worst case scenario, the employee uses the cash. They're using this cash value to pay off the loan, and they've got all of this benefit. And here's what I look at is the only out-of-pocket cost for our employee is $20,900 out of pocket to receive all of this benefit. So is that a win-win for the employer and the employee? Yeah. Everybody's happy. Our employees stayed for that 10-year period. They've got a great benefit for them and their family, and everybody wins. So this is a good thing to think outside the box as a way to have that employee retention. And I appreciate everybody being on, and we'll talk again next week. Thank you.